HDV is the iShares Core High Dividend ETF. It is designed to give investors exposure to 100 of the highest quality dividend-paying companies in the United States. HDV is run by BlackRock and tracks the Morningstar Dividend Yield Focus Index. The fund only includes stocks that have strong financial health, consistent dividend histories, and reliable income potential. Companies must also pass a screen for what Morningstar calls economic moat, which means they have a durable advantage over competitors. The fund is rebalanced quarterly and holds a very select group of companies with a focus on dividend sustainability. This ETF pays dividends every 3 months and has a history of consistent income backed by strong corporate fundamentals. HDV is not just high yield, as it is high quality. The portfolio includes large U.S. companies in sectors like healthcare, energy, consumer staples, and telecommunications. Examples include ExxonMobil, Johnson & Johnson, Verizon, AbbVie, and Coca-Cola. These are companies that tend to perform well in a variety of market environments and continue paying dividends even during downturns. As of now, HDV yields between 3.5% and 4.5% annually depending on the market cycle. That means for every $10,000 you invest, you can expect around $350 to $450 in annual income, paid out every 3 months. Unlike high-yield covered call ETFs that sacrifice growth for income, HDV focuses on long-term total return by owning dividend stocks with strong fundamentals. That makes it ideal for conservative investors, retirees, and anyone seeking stable, inflation-resistant income. HDV's strategy is simple. First, it screens the U.S. market for dividend-paying stocks. Then, it applies a quality screen to remove companies with weak balance sheets or declining earnings. Finally, it selects the top 75 to 100 stocks that pass both screens. These are the companies that make it into the portfolio. HDV's largest sector weighting is usually healthcare, followed by energy and consumer staples. These sectors tend to be more stable and defensive, which helps protect income during bear markets or recessions. One of the biggest advantages of HDV is its tax efficiency. Since the ETF does not trade stocks aggressively or use options, it produces fewer taxable events. This can help long-term investors reduce their annual tax bill and compound more over time. It also has a relatively low expense ratio of 0.08%. That means for every $10,000 you invest, you only pay $8 per year in fees. Over the long run, this cost efficiency adds up and helps maximize your dividend reinvestment. Now let's look at the risks. HDV is not designed for rapid growth. Because it avoids tech stocks like Apple, Microsoft, or Nvidia, it may underperform during bull markets when growth leads the charge. It also holds a concentrated number of companies. So if 1 or 2 major stocks underperform, the fund can feel that impact more than a broader index. For example, HDV is more vulnerable to energy sector fluctuations due to its large stake in Exxon and Chevron. However, that trade-off is intentional. The goal is to prioritize reliability and dividend safety over hype and speculation. If you want strong capital appreciation and fast growth, HDV may not be the best choice. But if your goal is to protect your capital, earn dependable income, and avoid excessive volatility, HDV delivers on that promise. You can buy HDV through any brokerage account, including Robinhood, Fidelity, or Vanguard. You can also set up automatic dividend reinvestment to compound your wealth over time. That means every time you get paid a dividend, it buys more shares automatically, which leads to larger dividends in the future. So how many shares of HDV do you need to live off the dividends? Let's say the current yield is 4%. To earn $400 per month, you'd need $120,000 invested. To earn $1,000 per month, you'd need $300,000. These numbers are based on simple math and do not include capital appreciation or reinvestment. If you reinvest the dividends and hold for 5 to 10 years, the income potential increases dramatically due to compounding. My meter rating gives HDV a strong 8 out of 10 for dividend safety, a 7 out of 10 for yield potential, and a 9 out of 10 for long-term reliability. If you want to sleep well at night knowing your money is working for you, HDV is one of the most solid dividend ETFs on the market. If you have any videos you'd like me to cover, say it in the comments below and I will break it down in plain English.